The idea of having an ownership stake in a company in particular is no new understanding, that we've had that component for many, many years. The shift was along around the 1900s, early 1900s, was the main populace, individual traders like yourself and me and Nick and people here on the desk. We generally didn't have enough money to actually be stockholders in a company. One share of General Electric in the early 1900s generally had a higher cost than an average person's mortgage. So it wasn't something that you could generally get to as an individual trader. And even if you had the means to get to it, it wasn't an easy process. The world was rife with very high commissions, very hard to obtain share ownership and things to that extent. So the first move to bring the broad populace into the investing mix was this idea of a mutual fund. What was a mutual fund? What was a pooling of investor assets with one fund manager in charge of that in particular. Now, why would those two things be the case? Well, one, the first component was that idea of how difficult it was to actually obtain and trade stocks back in the early 1900s, even towards the later 1900s, that it just wasn't an easy feat. We didn't have online brokerages. We couldn't buy or sell stock with the push of a button. There was a lot of hurdles and a lot of drag to creating an overall portfolio. So one thought process was investor assets and have the broader, larger amount of assets that they could use in that sense. And then the other component was a fund manager, someone who hopefully knew exactly what they were doing with the buying and selling of stocks. You could put your faith into the idea of a fund manager in the active management sphere. Now, fast forward to the late 1900s, early 2000s, one shift in the component of trading at that moment in time was this idea of a passive investing model. In essence, not necessarily having a stock picking sort of formula, the Peter Lynch's of the day that had been very popular with, say, the Fidelity Magellan Fund during the 70s, 80s, and 90s, but a shift instead to what if we just simply follow what the broad market is, the S&P 500, the Dow Jones, the NASDAQ, things to that extent. What if we could just replicate what the actual returns of those names in particular were? And what if we could do that in a cost advantage sort of way? Well, the first ETF coming in the mix, SPY, one of the still most actively traded ETFs on the market here today, that debuted in 1993. That was essentially an output of a passive index itself. And what was the main difference? And that's what it speaks to the difference here between ETF stocks and mutual funds. One of the drawbacks of a mutual fund was because it was a pooling of investor assets, there really wasn't the tradability aspect of the mutual fund itself. You were simply either depositing money into the mutual fund or you were withdrawing money from the mutual fund. And that too, if you were doing that too actively, it might incur its own commissions, it might incur its own penalties and fees along the way. So they wanted something that was very much like a mutual fund in the essence that it used the assets to allocate to a broad amount of individual stocks, but it also gave traders the flexibilities that were inherent to ETF traders at that moment in time. First one being intraday trading. ETFs give us the ability to buy or sell throughout the day. We can do so with really the only thing that is keeping us from doing that is liquidity in the market itself. And then at one point in time, commissions. Commissions were, of course, a drag to an active trading model for a bit of time. Now, granted, most brokers have moved to a very low or very zero commission model. Fidelity now has the ability, or Fidelity customers rather, have the ability to buy and sell stocks without a commission on domestic stocks and ETFs. So that drag has been reduced in a very significant way. So ETFs trading throughout the day allow traders to enter and exit positions on a regular basis if they so choose, but they also give you the full flexibility to not do that. You could hold them into perpetuity. You don't have to sell a ETF. So if you're thinking, if I am someone who was going to hold something for 40 years, the tradability is not that big of an impact to me. Well, an ETF still gives you that exact same ability if you so choose. You don't have to be a trader of it. The main difference is that imagine on a day like yesterday or a day like the before yesterday, you had the opportunity to exit a position during the day if you so chose. You don't have to, but you have the choice in that matter. So that flexibility in choices, tax efficiency, another important component of that shift in the ETF and mutual fund world. What does that mean? Well, mutual funds, they had the a benefit in the favor of the fund holder, the fund manager, that they were able and required and sometimes to spin off capital gains distributions on an annual or semi-annual component, which caused the traders, the investors, the holders of that mutual fund to be required to have to pay taxes on a regular basis. The difference of ETFs is that they reduce the exposure of capital gains through the method that they use to manage new inflows or outflows. And essentially, the only time that you create those taxable events generally is when you actually sell the stock or sell the ETF, rather. So rather than being forced to take capital gains distributions regularly, you are given the opportunity to choose when you take those capital gains by simply buying or selling the individual stock. Also, giving a new lens of transparency. Back in the day, active fund managers, they didn't want to have to report their holdings on a regular basis because they were afraid of kind of giving away the secret sauce that they had as showing positions to the rest of the market that they were currently trading in. ETFs are required to disclose on a daily basis what the individual components of the ETF are. Again, that used to be the active, or I'm sorry, the passive management of ETFs. Now we have a very active world still as well. And those active managers, again, are also forced to show what trades they have on a daily basis. And in that case, too, in the world we currently sit, we now have a variety of different investment choices within the world of ETFs. So why would someone choose that? Well, we got all those benefits, like I just considered, the idea of intraday trading, the idea of tax efficiencies, the idea of choices, but we also can use that as a tool in constructing a diversified portfolio. We can use it to fill gaps in the allocation that we have. Imagine if you were looking at your portfolio and you're thinking that, hey, I might be a little bit underweight in small caps. I don't have enough exposure to small caps. Well, you could go out and buy a handful or a dozen, baker's dozen of small cap companies that you feel great about, or you could allocate a small portion or however much you so choose to a small cap index. And again, the benefit sometimes of ETFs and passive indices and even active managed funds is this idea of not necessarily having to be a stock picker. We don't have to have the exact idea of what company might be a major beneficiary of a specific change in the overall market environment. Imagine a year or two ago, you were thinking, hey, I don't know what company might be the main beneficiary of this, but I really think AI could be the next big thing. What if we start seeing an AI trade become a major topic of conversation? Well, one component of it, you could have gone out and bought a couple of AI companies that you felt very strong within. But also, we could have found a thematic ETF that was looking to trade on this change in the thematic AI world. And lo and behold, a year or two later, names like NVIDIA or Supermicro Computers or names like that, they were the major beneficiaries at this moment in time. And that could have still given us a decent amount of profit to the upside on an ETF that had exposure to those names. This idea of the expression of a general thought process is now an important consideration that we can use in thematic ETFs and sector ETFs. If you're thinking the financial sector or healthcare sector, they are going to have a tailwind of something in that respect. Well, we don't have to find the individual company or companies that we think are going to be the main beneficiary of that. We can find an ETF that is an important component. Now, what are the costs that we need to be considerate of? I mentioned commissions. Those are no longer quite as hefty of a component of the individual cost considerations. But say if you are someone out there trading outside of Fidelity, well, they might still have a commission. Some brokers still have somewhat of a commission out there. An important distinction, though, that is the same with mutual funds, this idea of an expense ratio. So what is an expense ratio? Again, it's the cost that the fund charges to essentially keep the lights on. How do we keep the analysts paid? How do we make these decisions? How do we then use it in that same component along the way that we use it from the perspective of having a price in mind of creating and managing this fund in particular. So the expense ratio represents the total fees that are charged to us. It is not a line item fee that you pay on a regular basis. It is something that is subtracted out of the fund itself, the net asset value versus the public offering price and how that is tracked and what that means from the perspective of a drag on the portfolio, if anything. But also liquidity. Liquidity is still a major component of ETFs, especially ones that are somewhat less popular. Something like I mentioned SPY earlier. SPY is generally a very, very liquid product, one of the more liquid products out there in that same mix. The difference, though, imagine something that had a much wider bid-ask spread. Well, why does that matter? Well, for something like SPY, if you were a buyer of SPY and it has a 1 cent bid or ask, well, we know that the moment we open a position, we buy a share of SPY, we're at a 1 penny loss. So, in essence, to be able to be profitable on that security, it has to go up by at least 1 penny. That is a very low hurdle because it's a very liquid product. What if, though, instead it was something with a 50-cent spread? Well, now the underlying ETF needs to go up by at least 50 cents before we are at a profit on that security. That is essentially a drag that is to be found on the portfolio. It's this idea of what's called slippage. The idea that if we accidentally allocated a buy order to this when we didn't mean to, we needed to get out of it right away, what would be the cost of us doing so? Imagine same thing if you were to have been a buyer of a house or a real estate transaction and you needed to turn around and sell it right away. Most people would anticipate having to take a haircut because of the fees and things associated with selling real estate. That is a similar component to the liquidity mix of ETFs. And like I mentioned, it's just a way that we need to approach the different markets out there. So understanding what is the liquidity of this by looking at what is the daily volume compared to its counterparts, what is the bid ask spread, and how can we use that as well as the net asset value mix. Is it trading at a premium to its net asset value? Is it trading at a discount to its net asset value? Understanding what is the fund really attempting to track at a given moment in time, and is it doing a good job at tracking that? So, plenty of things to be said about ETFs themselves. I saw a couple questions that came in. I'll look at those before we pass it over to you here, Nick, and give you a chance to introduce yourself here today. JW asking, is it a good idea to balance stocks ETFs when you're growing your IRA or rollover? I think it really just comes down to what is the end result that we're trying to achieve, because we have to figure out what type of trader that we are. If we are someone using stocks and ETFs to allocate, say, in a swing trading, day trading basis, well, both of those things, stocks and ETFs, can be a good tool for that to be the case. Same thing can be said on a long-term basis. And we can see what that means from the perspective of having the individual component of the trades themselves, what that means from the perspective of deciding what our overall portfolio looks like. And James asking, having some mutual funds for a long time, should I consider changing them to the comparable ETFs? That's a choice. That is a choice that we have the ability to do. I would consider all of the components of having to exit a mutual fund. In essence, say if you have a large capital gain, that is one thing to kind of go through that pros and cons list. But again, ask ourselves, how important are those flexibilities of an ETF? If we have the ability to place trades on a regular basis, if we have the ability to potentially be more tax efficient. Before I pass it over to you here, Nick, I wanted to mention as well, I'll actually be back Thursday of this week at 10:30 with some guests from iShares to really deep dive into a lot of these similar concepts, ETFs versus mutual funds, as well as their offering of ETFs that tend to be a very popular mix. But I know I've been going for a solid few minutes here, Nick. Anything you wanted to add to the mix or anything you want to take a look at next?
Yeah, JW actually had a similar question on, ETFs versus mutual funds and such. And I'll share with the audience, a little bit about, ourselves. For one thing, we do have a very robust workplace savings account. But, unfortunately, as, Fidelity employees, we don't have the ability to trade individual stocks in our 401k plan. And some that actually goes back to working for a brokerage firm. They have to, especially if you're part of the fund specific people, there's a lot of monitoring they have to do. And I know some of those people that can't even trade individual stocks because of blackout periods, etc. That said, however, many of us on the strategy desk, we do very actively manage our non 401k such, but I see very, very common with active traders where they might have, their retirement accounts in exchange traded funds or mutual funds, and then they'll actively trade stocks in their non-retirement account, to give them a little choice, or they'll trade options in their non-retirement account compared to their stock account. So a couple really great questions there, but I did want to shift over, and I wanted to take a little bit of a deeper dive into a couple of things. I know Andrew mentioned some tax efficiency. This comes back to that concept of passing capital gains. And I know when we have this particular session, we always get asked more questions on, well, why are ETFs more tax efficient than mutual funds? As Andrew mentioned, mutual funds do have to pass on their capital gains, but why do they get capital gains and ETFs don't? Why don't ETFs have to? Well, it comes back to when you're purchasing a mutual fund, you're actually purchasing it from the fund sponsor. So you give them cash, they give you shares. And then you say that, well, I want some shares back. Sorry, I want some cash back. Well, they have to go and they have to sell some of the stock that they own. And they're constantly buying some shares to invest their cash, selling some shares to free up some cash because they're trying to keep just enough cash to cover that couple days of either disbursements or money coming in. And when you might have events like yesterday where the market really dropped and all of a sudden traders like sell, 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 get me out, get me out. Well, they might have to free up even more to accommodate that. And then they wind up having too big of a cash position and it kind of throws off their numbers. If they have 5% of their overall investment in cash, well, then it's going to underperform the market because they have too much in cash. So because of these buys and sells, they're selling stock that maybe they bought a month ago, a year ago, 3 years ago, and they then have capital gains and losses off that stock. Well, they then have to distribute those gains and losses out to shareholders and such, and that's where those distributions come out. ETFs, on the other hand, don't have this mechanism. You're not actually redeeming shares from the sponsor. You're simply trading them to somebody else in the market. And as such, a ETF sponsor doesn't have that issue with that extra cash without having to like sell shares and buy shares to create more shares. Instead, this is done through the concept of creation units. And with these creation units, what will happen is you'll have a very large fund sponsor, and or maybe this could be BlackRock and then Fidelity versus Wells Fargo, et cetera. You have another big participant, and they'll package up a bunch of shares. So if you have something that tracks the S&P 500, they'll go and they'll buy millions of dollars worth of stock that correctly proportions the S&P 500 into what's called the creation unit. And they'll turn this creation unit over to the plan sponsor in exchange for more shares. And those shares, they then sell to the open market. And then the flip side of when maybe they're taking shares out of the market, they'll exchange shares to the sponsor for shares of the underlying investment. And then they sell the shares. And then so those that appreciate or depreciated stock is then transferred over between institutions. And they then don't have to worry about that like individuals like you or I might have to worry about that. Now, this also comes into how ETFs can track something really well. If you have an ETF that tracks the S&P 500, well, if it's trading at a slight discount to where it should be, well, a large authorized participant will go and they'll buy up a bunch of those shares. They're trading at a discount until it's lifts it up to where it's trading where it should be. And what they'll do simultaneously is they'll sell shares short of the broader market. So they'll be long the ETF, short the shares to balance it out. And then they'll take those ETF shares and they'll go to the sponsor and say, hey, give me shares of the underlying. And they'll then use those and deliver and close out their short position. The flip side, if it's trading at a premium, trading at $101, it should be trading $100. Well, they'll go out and they'll buy a bunch of the stocks to create a creation unit, and they'll in essence pay $100 because that's what it should be trading at, exchange it for shares, and then sell those shares until the price gets back down. And this also provides that mechanism for kind of distributing out those capital gains or losses to those authorized participants and not the actual holders of the ETFs. So this is how it gets its tax efficiency, is that if you buy shares and the shares appreciate, if you bought shares of SPY, in 2008, when it was bottoming out at $70 a share, and you still have them now and they're worth $500 a share. Well, the only taxes you might have paid would have been on dividend distributions. There hasn't been a capital gains distribution. You won't owe capital gains taxes until you choose to sell to close your position, as opposed to having that distributed out. So that's where that advantage comes into play. Now, if you're trading in your IRA, who cares? Taxes are deferred. You either pay taxes on everything that comes out, or you pay taxes on what went in, and then it's tax free when it comes out if they're qualified disbursements there. And so that tax advantage in IRAs then kind of loses a little bit of its luster. This then comes back to some of the other advantages of ETFs at intraday trading. If in the middle of the day, yesterday you wanted to get out, you could. The market boom dropped and then it recovered and that kind of sold off, and you could have sold it at noon yesterday if you wanted to, or 1 o'clock, or 9:31 in the morning. You have that ability. And many traders that they might just be indexed the broader market, they might take advantage of that, especially, you take last Wednesday was a Fed day. The press conference is at 2 o'clock. Sorry, the press conference is at 2:30. The release is at 2 o'clock. They might have chose to get out at 1:55 before the press conference, and the release rocks the market. And you can do that with ETFs, where you don't really have that ability with mutual funds. There are some mutual funds that trade more than once a day, but most only trade once a day. The variety of choices, though, you're starting to see many, 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 many choices on both of them. But the transparency is another big thing. And just as Andrew mentioned, giving away the secret sauce. And so as such, these active fund managers don't want to then manage an ETF, because then everybody knows exactly what they're doing. Take Warren Buffett. It was a big news article out on, I believe it was Friday or over the weekend, that he'd cut his position in Apple in half. Now, most likely he didn't do it on Friday. Most likely he'd already been doing it for several months, and potentially up to 4 months ago, the previous quarter kind of thing. He was doing it from in essence um, April to June. We just found out about it, in August. A month late. He could have been 4 months ago. Or if this happened under the ETF, immediately, oh, Warren Buffett's selling this. You get this transparency, at the end of the day. And so you might look at it and go, well, why should I pay the fund manager 1% when I can just see what they do and duplicate at the end of the day? So that transparency can be an issue from the actively managed perspective. But, getting into some of the costs and such, many, many traders, many of those talking heads out there say ETFs are cheaper. You should trade ETFs. ETFs are better. Well, this actually gets in the argument of indexed investing versus active investing. Active management, it's very, very difficult to year after year after year after year beat the market. It just is. One particular fund that always sticks out to me, this is a contra fund. I'll pull up an example of this. Now, I remember being a regular service trader at Fidelity and always getting calls on, Nicholas, the market's up 10% this year. How come your fund's only up 8.5%? Why aren't you beating the market? And we just felt like it was every other call. Why aren't you beating the market? Why are you underperforming? Well, this fund, contra fund, managed by William Danoff, there was a Wall Street Journal article out about it that probably 6 years ago now, because it was about a year or two before COVID, and it talked about that in the 25 years he'd been managing the fund, he's actually beat the market on average of 3% per year over 25 years. How do you pull that off? Well, in 2001 to 2003 timeframe, the 2009 timeframe and such, he didn't drop as much as the market. He managed risk. And so he carried a 0.85 beta, meaning he didn't go up as much as the market, But the bigger thing is he didn't drop as much as the market. And so this kind of goes back to that if you drop 20%, you only need 25% returns to come back to break even. If you drop by 50%, you need 100% returns. And that's how he, on average, beat the market over the 25 years. But that's also a longer term perspective. And sometimes you get shorter term traders with that. And so it's still very, very, very difficult to consistently over the long term beat the market. So as such, why a lot of traders go, well, why pay somebody 1% when they have to beat the market by at least 1% just to offset the cost? Well, look at index investing. That said, with index investing, I'm going to shift over one of the most popular ETFs out there, most actively traded ETFs. This is SPY, S&P's Depository Receipt, SPDR. Spider is its name. And we take a look at its expense ratio, 0.0945%, just under 0.1%. This means if you have, $100,000 invested in SPY, you're going to be paying $100 a year, having, in expense ratio, which is pretty cheap on that considering. Considering that, if you're paying 1%, it'd be $1,000 a year on that. Now, this is in comparison to something like ContraFund. ContraFund used to actually have about a 60 basis point expense ratio. I remember it used to be 80. It's now about 40. So it's about 4 times SPY. So SPY is 25% less. It is cheaper than the ContraFund based on the expense ratio. But again, the ContraFund is actively managed. William Danoff has a staff, has expenses and such. An office building, got to keep the lights on. It's a lot more expensive to actually have an active manager and a staff than is just to have a computer algorithmically. Just got to make sure the server room doesn't catch on fire with the passively managed funds. So this actually is pretty cheap now, but still, this is a quarter of the price. Now, you might go, that sounds really cheap. Now let's look at competitors. Go to comparisons here. This has some competitors, some similar products. VOO, Vanguard's 500 fund. IVV, iShares 500 fund. Andrew mentioned that he has a presentation with iShares coming up on Thursday. Fidelity does partner with iShares for this. And so let's take a look at the iShares product. 0.03%, a third even of what SPY is. This is even cheaper. This also does the same exact thing of being indexed, tracking the S&P 500, and both of these products do a very, very well job. But, let me pull up another product. This is FXAIX. This is a mutual fund that is also an index fund. It is a passively managed mutual fund, indexed the S&P 500. Take a look at its expense ratio. 0.015%, even half again what IVV is, fully 1/6 the cost of SPY. Now, why do I jump on this? Why do I talk about this? So the argument on ETFs are better than mutual funds because ETFs are cheaper than mutual funds. Not necessarily. Indexed investing is less expensive than active investing, and frequently the extra alpha generated by active management, and that alpha could be positive or negative. It's the active returns is what I'm addressing. Isn't worth the extra risk, so to speak, frequently. Now, let me pull up another example. This is another well-known fund, ARK Innovations, ARKK. Take a look at its expense ratio. Almost double what the ContraFunds is. And this is an ETF. And so we can see ETFs aren't necessarily cheaper. They're just typically indexed, and as such, indexed funds are less. Now, that said, this is a quasi actively managed fund, and they're starting to create some of these products where ETFs can be actively managed. They get around kind of disclosing their secret sauce because they're able to disclose what's called a representative basket of their securities. So they're not necessarily giving away their exact position sizes of what they're exactly invested in, but they could say, and I'm being very general, they can say so much invested in semiconductors, but maybe not specify is it Sun Microsystems, is it Taiwan Semiconductors, is it Nvidia, is it kind of get the picture with that, where they can get a little bit of anonymity on what they're investing in, so don't give away their secret sauce, and therefore they can have this actively managed fund. This kind of also bleeds into, we're asked about the Fidelity Growth Fund. Does Fidelity offer, ETFs, comparable ETFs? And some of those products we do. If you come up to a course, we'll go to products and then ETFs. And this is products versus news and research, because here's where you can actually dig into and actually see some of Fidelity's ETFs on here. And I know some products like the Contra Fund doesn't have an ETF corresponding, again, because it gets to that disclosing what you're invested in. And it's kind of giving away the secret sauce of what William Danoff has invested. But we do have some that match some of our mutual funds and such. Now, that said, Vanguard was very well known for that, where they have ETFs that match their mutual funds, and you can kind of convert from one to the other. Well, this kind of goes back to indexed mutual funds in a comparable indexed ETF, where kind of shifts back, and you could kind of convert shares from one to the other, but not go back the other way, kind of thing with that. So, Andrew, I just wanted to elaborate a little bit more on some of the why the tax benefits there, how that happens, the expenses of ETFs. That while you might have heard the ETFs are better because they're cheaper, they're not necessarily cheaper, but that ability to trade continuously throughout the day, that's a big benefit. Now, one thing that mutual funds still have, and this is very, very advantageous for somebody that's saving for retirement, is let's say you put back $100 a week in your IRA account. You can actually set up an automatic investment to automatically purchase $100 worth of mutual fund once a week or once a month on the 1st and the 15th, twice a month. You could do that. Or with ETFs, it's you can't do that. Now, you can buy fractional shares now, which was very different, compared to 4 or 5 years ago. So at least now you can go and you can place a trade to buy $100 worth of SPY versus waiting until you had $540 to buy one full share. But you have to manually do that. So that's still an advantage that mutual funds have. Kind of the buying and selling in dollars is still the normal, compared to shares. With that though, Andrew, I know is talking for quite a bit as well. Anything that you might want to add?
Yeah, a couple questions that came in, a couple things to add as well. I'll hit a few of these questions just rapid fire, and we'll move on to the screener. I know that was kind of the main bulk of today as well. But first one, someone asking about the recordings. Unfortunately, this session not recorded for review purposes, only for internal compliance purposes. So there's not a way to access it after the fact. Someone also asking, are there rules about selling stocks and ETFs repeatedly? Say buying today, selling a couple of days. Yes, there are a kind of a full rule book of what you can do in short-term trading rules in that respect. Something to keep in mind as far as good faith violations in cash trading accounts or day trade calls and things to that, and extended margin accounts. If you have questions about that, feel free to call into our active trader desk to discuss that further. Someone asking too, why would we buy mutual funds today when ETFs exist and have a lot of the same components on the pro side, but remove some of the cons? The way I generally position it is there's a few people who generally still use mutual funds. One is something Nick mentioned. Some people are still just forced to only choose mutual funds, especially in retirement accounts. I know that is something like Nick mentioned earlier. Us personally, we can only choose mutual funds in retirement accounts. So that does take away some of that flexibility. We are given only the choice of mutual funds, and that is still the case with a lot of people's individual retirement plans. Outside of that, two other things that I can think of as a potential pro, and it kind of depends on the individual person. One, maybe you do have a mutual fund you've held. Imagine if you were a Contra Fund or Magellan Fund trader and and holders from the 70s and 80s. Maybe there's a very large capital gain that you're sitting on that you don't want to close out at any given moment in time, then that's an understandable, piece of the overall choices that you have is how much capital gains are you potentially incurring by closing something if you the only express purpose is to move it into something else similar. In that case, are you not getting, more of those pros out of the benefits versus the cons of the tax bill in that scenario? Another pro that I've often heard, it just comes from the discipline side of things, and this is kind of an interesting thought process through the lens of self-regulation in that respect. That I've spoken to traders who they appreciate that mutual fund can only be bought or sold at the close because it forces them to only do that once per day. And that's a way that they could self-regulate that component. The other side of that, you could force yourself to only trade the ETF once per day, but in taking that choice away, I've heard some traders say that that was a potential pro on their end. But I would say that for most people, they at least appreciate the flexibility that the ETF gives
Yeah.
them. If that is something that is keeping you from that perspective, that is something always to consider. And maybe we, close our eyes, close the laptop until 3:59 every day and wait to see what happens at that moment. But nonetheless, I have spoken to traders who it's a way of keeping themselves in a rule book to only be able to trade it once per day. Bob asking about the expense ratio. How do we pay that? Again, it's not something actually that you write a check to, see a line item withdrawn from your account with the expense ratio. It is factored in to the cost of the mutual fund. So theoretically, if the market returned 10% that year and they have a 0.01% expense ratio, that it's going to be slowly factored in to the actual public offering price and net asset value component of the mutual fund. So it's never something that you actually see, but it is something that over the long term, it would be an important drag or less drag comparatively to others on the portfolio at that moment in time. And then James asking a really fun question that speaks to something that Nick mentioned. So there's often this kind of component of the markets of this idea of active versus passive. And this is something that, of course, many people talk about, that the biggest active fund managers generally, and this is, a fact, they tend to underperform the broad markets because one thing that is slightly different when you are a large fund manager is that it sometimes is hard to beat the market with a large fund in that respect because of the different constraints of a large fund. And the way that this is generally positioned is that, hey, if the smartest traders on Wall Street can't beat the market, how could individual traders? But the difference on an individual retail trader and active trader sort of component is that we aren't beholden to the same sort of constraints that an active manager can sometimes be beholden to. One process of that is they are, by decree of the mutual fund, the objective of the fund, they have to be invested essentially at all points in time. So in periods of a drawdown, sometimes those active fund managers, they will, seek safety in other assets and other sectors in that extent. But that's an old saying that when things are going down, sometimes correlations all go to one. And that can be an important consideration of, say, like 2022. The broad market fell 20 to 25%, but basically every other sector also fell 20 to 25%. So even an active manager, if they tried to get out of large equities and into something safer, they still probably suffer that drawdown. An individual trader, theoretically, a trend following trader, maybe as an example, they could have been in cash during that period of time. They could have avoided a large portion of that drawdown because they are not required to be fully invested at all points in time. And that speaks somewhat to maybe the idea of active management. And that doesn't mean day trading, swing trading, doing something very often. Maybe it means that you're holding a long stock or somewhat of a portfolio in those prevailing uptrends, and we are exiting and moving to safety positions when those markets are moving downward. And we aren't capturing maybe all tops and bottoms exactly, but we're able to capture the predominant amount of a trend in a risk managed way. So sometimes there is that apples to oranges approach of mutual fund managers to individual traders in the essence that they're the smartest people out there, but they also have rules that we're not beholden to. And two, imagine, the difference of, say, if you were managing $50,000, how easy is it to get in and out of a position in a smaller account or even a $10,000, $1,000 account? You can do that seamlessly in seconds. Imagine if you were managing $5 billion. How much harder is it to move $5 billion across a broad market? If you were someone, if say this, not necessarily a passive index, but we were looking at, I think it was ARK earlier, if ARK said that, hey, we're looking to be more involved in Tesla. Well, they flash to the market that maybe $1 billion is going to Tesla. The market tends to front run that. It makes it harder for them to actually get in at an advantageous price because of how much money is trying to get in at all one point. And then when they try to get out of it, the same thing happens to the downside. So it's harder, ironically enough, for these large funds with the smartest people that we could hopefully find to run these funds to actually do better in prevailing up markets. That sometimes the nature is that it's hard to beat a market that has moved to the upside if you're an active fund manager, versus maybe you can just do slightly better in those downturns, kind of like Nick was mentioning, that beta component that you underperform in the uptrends but you overperform in the downtrends and you create a little bit of a better risk management. So it's a fun subject that I always kind of enjoy thinking about from that market lore perspective. That fund managers always tend to underperform the market, but they have a hurdle that's a little bit harder for us to rationalize compared to individual traders or even smaller funds and firms in that same respect. So the next thing that we wanted to take a look at was that screener, how we
And
compare. So sorry, go ahead there, Nick.
and real quick before you do that, because I know we got some questions that wanted to elaborate a little bit on expense ratio. Like Andrew was saying, it comes out just the performance of the fund, and we can see that with alpha. This is in essence negative performance here. Negative performed 11 basis points over 1 year, about 0.08 basis point. 8 basis points over 3 years on average, and such. And so this is where we can kind of see where that about 9 basis points worth of expense ratio is coming out of IVV, close to that 3 basis points expense ratio coming out, sorry, of IVV, the 9 coming out of SPY. If we come over to FXAIX, the average annual returns, going out, 5 years, it's 14.98 versus 15, rounding up that 1.5%. 10 years, 13.14 versus 13.15. So we can see it's in essence, it's if the market's up 10% and it has an expense ratio of 0.1, well, after a year, you're going to be up 9.9% is effectively the way that expense ratio comes out. With that said, Andrew, let's go ahead and jump over into the screener.
Yeah, absolutely. So as we mentioned earlier, the important now thought process is, all right, Nick and Andrew have done a pretty good job of selling us on the idea of ETFs from an abstract concept. What are we actually looking at as far as ETFs go? How do we actually find an ETF out there? Well, like we mentioned, the kind of very popular ones tend to be well known, the SPYs of the world, the Qs of the world, things like that. But if we're looking for something from maybe a more active management or maybe a smaller sector passive management, how do we ultimately would do this? So first thing we want to do, news and research. If we go to ETFs underneath news and research, it will take you to this page in particular. This is where you can actually look at different components like Nick was just mentioning, but also we can pull up a screener of ETFs themselves. So a couple of pre-built screens that we find here. Fidelity ETFs is one of them. Fidelity does have a suite of ETFs. Let me pull this up real quick and then we'll take a look at a few of the others. But Fidelity does have ones that you can actually look at from that same perspective as the other ones. It's for some reason not clicking when I do this. Let me just relaunch this page and do it one more time. So if we're looking at the Fidelity different ones that we have choices of, well, we can choose what type of individual ETF we're looking for. Active ETFs, thematic ETFs. I've been a big fan of talking about thematic ETFs. We've actually even have a session on thematic ETFs because if we think about this idea that I mentioned earlier, imagine if you were someone just simply thinking, hey, I really think X thing is the next big thing. How then do you go out and determine what is the best company to be allocated to? So let me see if we can find one. Disruptive technology is probably a good example of what I was just referring to. Disruptive technology can mean a lot of different things, but imagine if you were thinking that, again, AI is the next big thing, or you were thinking about that maybe a year or so ago, and now you were then considering, well, what company could be the best beneficiary of AI? Let's see how this fund has done over the last 5 years. Well, yeah, we've seen since that downturn in 2023, it looks like this was actually launched in 23. This has gone from, was this about $22 all the way up to $35? So essentially a 50% move during that same period of time. It has come down in the last downturn to some degree, but how then was it made up of? Well, it's got a lot of different companies that have had a headwind and tailwind from the perspective of this move in a theme. Imagine again, last time, you were thinking, what company should I invest in if I think this is the next big thing? Maybe you would have said Nvidia, maybe you would have said Taiwan Semiconductors or Microsoft, but maybe you might have chosen something else. It's the same thing that can be said if we look with that benefit of hindsight of the dot-com era. Imagine in 1999, 2000, you were thinking, websites, the internet, next big thing, and you go out and you buy all of these companies that some of them no longer exist. So you imagine if you bought pets.com or AOL or Yahoo or things like that. Those ones didn't pan out. What did pan out? The Amazons of the world, the Alphabets of the world, companies like that. Would we have thought that the, book selling Amazon.com was going to be one of the biggest beneficiaries of the dot-com era? We probably wouldn't have thought that at that period of time. But had you held an ETF or even a NASDAQ ETF in that sense, you would have been the beneficiary of those companies that did end up working out, and the ones that didn't end up working out would eventually be removed from that index or that ETF or something to that extent. It removes that necessity to be a full stock picker. Now, what
There's
is the
survivorship bias
trade-off?
as well.
Right, exactly. And what is the trade-off in that scenario? Well, imagine, let's just simply look at something like QQQ as a quick example. This is a trading ETF based off of the NASDAQ 100 to some degree, and the major holdings here, Amazon. Now, how much of the performance of this one, let's go back to this move since the early 2000s, how much of the performance since this period where it was going from 4 to 30 and now it's 435, a 10x move? Well, in that same period of time, Amazon was up about 25,000%. So had you actually picked Amazon, you would have been in a much simply specific better spot. But what if you picked one that didn't pan out? What if you picked the pets.com? What if you picked the Yahoo or the AOL and the ones that no longer really trade in the same capacity? You wouldn't have any position in that now
Yeah.
currently. So that is the trade-off, is that we will theoretically get less performance because we are not individually allocated to something that could outperform. Instead of being 100% invested in Amazon, you have 5% of your portfolio in Amazon. And as it gets bigger, well, then you might be the beneficiary of that move. But if it were to become smaller, it is going to make up a smaller portion. It's going to have less of a drag on a portfolio in that same degree. So on the
What
screener page, oh, go ahead there, Nick.
one big example that I always think about is I work with a lady in the, like 2013, 2014 or something like that, that she had two positions in her account. This was a retirement account, $3,000 contribution from, the early 2000s. The first was Enron. And we all know what happened with Enron. And at the time, the position wasn't worth anything. The second was Apple. She purchased $3,000 worth of Apple in 2003, 2004. That was now worth about $225,000. So did really well. So there's examples of that extreme where strikeout, grand slam on that, but it they could have both just been regular mediocre hits, so to speak, and not done anything. And what I think about with that is, one of the former largest companies in the S&P 500, ExxonMobil. What has it done over the last 15 years? Really not much since it was the highest. It's kind of gone sideways, for the most part, where there have been some other companies like Apple, Microsoft, Google, and such that have really overtaken it. I just thought I'd add a little bit of additional color commentary there, Andrew.
Yeah, absolutely. And it speaks to the risks of individual stock ownership. By all means, it is a two-way street in that respect, that you could have significant outperformance on an underlying, but you could also have significant underperformance, and God forbid, a company go bankrupt in a very short period of time, like an Enron style example. So this is, again, a benefit of diversification. And it doesn't necessarily mean diversifying against a broad sector. It can just mean individual removal of that idiosyncratic risk. We've seen one name in particular on the kind of note of AI and computing and things to that extent. Intel, very rough, a few days, weeks, months now trading below, I believe it's 1990s style of periods in that same price action. So keep that in mind, is that I believe the stat, of course, don't quote me on this, is that 90% of stocks underperform cash in their overall lifetime because of this broad amount of companies cease to trade. And we create that bias that Nick mentioned earlier, survivorship bias. We remember a name like Amazon fell 90% in 2000, 2001, give or take, then went on to make 50,000%. And we forget all of the companies that ceased to exist. We forget that component of some stocks simply do not recover after a broad amount of distribution. But again, to go back to these areas and go back to the screen, let me just relaunch the screen itself to make this back to its base level. You have the ability to screen on a variety, essentially dozens of different criteria that we find here. So let's just take a look at a few different screens that we can make in real quick time. Let's first think about ones with a overall kind of higher level of actual net asset value, actual assets that they have underneath their wing. Let me see if I can find that one here, net assets. So let's add that one first. Let me just go ahead and hit apply criteria. And let's look at ones with kind of a very high or high sort of allocation, ones that have a decent amount of investors, as we mentioned earlier, SPY and IVV, VOO, those tend to be those higher ones in that respect. Then let's also look at a few different components here. Let's maybe look at what it ultimately tries to do, what maybe it's done here as of late. One thing I kind of like to take a look at is ones that are very new. Let's see how many new ETFs exist over this same period of time. We've seen a few ones come out in this past year. This is a very interesting one, a hedged equity ETF. What could that potentially mean? This is actually something we'll be discussing in that Thursday session here this week, of the idea of options being added to ETFs and creating different outcomes in that respect. Let's see what its overall component and what it's trying to do here. It seeks capital appreciation, normally investing at least 80% of equities in securities, investing in securities of the S&P 500 and the Russell 1000, but employing an options-based strategy designed to provide downside protection in certain market conditions. This has been somewhat of a shift in the world of ETFs in, say, the last, really just the last year or two, because there's been a big shift in the options world, especially the interest rate environment, that now we can potentially use options with the combination of shares of underlyings to create defined outcomes to some degree. The ones that we'll maybe take a look at, ones that provide downside buffers on a specific percentage basis, but retain a certain amount of upside caps. If you've used options at any moment in time, you kind of understand what we mean. We have a trade-off in some degree. So another way that we can look at this, let me remove the inception date component. And another component is maybe looking at ones that have a difference of what has happened maybe from a technical perspective. Let me then add these net assets back one more time so it resets everything very high, and high will make the responses here. We'll see probably SPY and IVV. And something we mentioned is the idea of technical analysis and using components of this. What if we just want to see something that is above its 50-day moving average? We can look at every single ETF that has a decent amount of assets and then is simply above a rising 50-day moving average, or simply above its own 50-day moving average, to get some sort of component of whether or not it is an up trend. We can use that same sort of component here. We know that SPY and VOO and IVV, they're all below a 50-day moving average. So what are ones that are potentially rising during this period of time or above this? We see GOVZ is an example of this one. This is most likely just going off of Gov being in the ticker symbol. It's probably has something to do with treasury bills, as we would anticipate here. And what has this one done during this period of time? Well, we can look at the chart in particular. We can do this additional due diligence. So we can see that it has risen in the last few days where the rest of the market has fallen due to that change in the overall yield environment of bonds during this period of time. So the screener, what is it ultimately allowing and giving us the ability to do? It is giving us an ability to look at all of the different ETFs out there, and I'll clear all just so I can show this one more time. Let's say if I add the net assets here, it'll give an example of how many are out there. There is roughly 3,300, or actually 3,500 different ETFs out there if you include the leveraged or inverse securities. How then do we decide which ones are we looking for? That's what this screener gives us the ability to do somewhat, is remove, hopefully, thousands of different ETFs, whittle us down to a list of maybe 10 to 15, maybe 20 or so, that we can then do additional due diligence on to see if it fits what we're ultimately trying to achieve. So no, we're already, just coming up on the time allotted here today. Saw a couple questions come in. Anything you wanted to add to the screener before we start to wrap up here, Nick?
One of the big things I want to add, or really repeat, is do your due diligence with some of these names. And I mentioned this especially when you're digging into, emerging markets type of securities. We'll see some securities that have virtually identical names, just one's, MSCI, Morgan Stanley, um, you know, investment. The other might be iShares, the other might be Vanguard, might be Wells Fargo, whatever it might be. They might say the same thing, but as you then dig into it, you see their indexes are slightly different, and as such, their investments are very different. One might be cap weighted for emerging markets, in which case 70 to 80% of it's going to be China or Asian markets because that's where a lot of cap is. Or it might be weighted a little bit differently, where you might then see a lot that's in, South America and maybe only 30% of its Asian markets. And the name is the exact same name, just one's the Wells Fargo version, one's the Morgan Stanley version, one's the Fidelity version, so to speak, but their investments are very different. So be sure you do your due diligence, you do your digging into it, just to make sure that what you're investing in is actually what you want to be targeting in. Now, that said, when it comes to emerging markets, ETFs are a great way to get exposure, but they can also be trading at a severe premium or discount, compared to the net asset value, and that's okay. And this comes up with China as a big example because China has had in the past a lot of capital controls. And when the Chinese market was dropping, the regulators actually came out and said, you can't short stock. You can't sell more than a certain amount of stock as well. So traders that then didn't want to have their exposure or they wanted to bet on it dropping, they couldn't short Chinese stock. Well, what could they do? They could come to the US market and they could short ETFs that hold it, betting that those are going to go down. And that's then what they did. And those products were then trading at a discount, a substantial discount, and did so for an extended period of time. That can happen. Likewise, some might be trading at a substantial premium. That can happen for quite a bit of time. So keep that in mind when you're digging through that some products like SPY, IVV, VOO, tracking the S&P 500 have very great mechanisms to reduce tracking error to a very, 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 very small amount and you trade at 0.01% premium and discounts. Other products might be trading at significant premium or discounts. You'll definitely want to do a lot more digging with that. Just thought I'd add that in there, Andrew, as we wrap up.
Yeah, absolutely. Well, a couple questions to hit before we wrap up here today. The first one, which is better to screen, a 50-day or a 10-day moving average, and why? There's no right answer to this. It's the funny thing about technical analysis and trading and things to that extent. Let me just show an actual chart from that perspective, and we can see maybe with the benefit of hindsight what might have been better during a period of time. I'm going to modify this 100-day to a 10-day just to show with some granularity here of which one might be more beneficial. And again, there's no right answer because the question is generally going to be how much leash, so to say, are we giving a trade before we are trying to exit from a trending basis? So if you have a very short time horizon, you're trying to capture, maybe individual days, a couple of days worth of information. Well, being above a 5-day, 10-day moving average is beneficial for that. Say, look at this period from May. We could gapped above the 5 and the 10. Had you been a buyer, say at the open that day, 51.22, and then got out on roughly the day that it breached both of those with significance, then you were able to capture 140 points in that period. But what's 140 points for a long-term portfolio? So if you are someone maybe using a very long-term basis, well, then maybe you are only looking at the 50-day moving average. Had you done that, well, you got in maybe around this time here was at 43.50. You got out right around this area here, that one being about 50.60. So in that case, about 700 points that you're able to do so in a risk managed way. And the same thing can be said when we got back above that here, give or take 51.80, got out at this point from a 54.46. The also other side of it is imagine if your thought process was, I want to be predominantly long 70, 80% of the time, but I'm trying to avoid the big one, the quote unquote big move to the downside that we want to avoid to some degree. Maybe we then switch to either maybe a very long-term daily moving average. Say if you look at the 200-day as a proxy of those longer term trends, or maybe if you look at the weekly moving averages, very similar components here. Imagine if you simply use the concept of a 50-week moving average. Well, for most of the 2010s, you were long here, but this COVID move, the first week of that move post-COVID, it would have shaken you out at about 29.50. That would have hurt. Moving from 33.37 to 29.50, that was a 10% move in a week's time. That's a substantial move to the downside. But then you avoided that move from 29.50 all the way down to 21.91. You avoided another 25% drawdown, and then you got back in essentially right at 29.50. You missed like 1% of the move to the upside here, and then you were able to capture all of this move from 3,000 to what this be about 4,400, a 50% move almost in that period of time in a risk managed sort of way. An area that you say, I'm willing to be long above it. I move to cash or move to safety if it is below that because the market is in somewhat of a distribution. Same thing can be said here. You got out, call it 44.30, or maybe this is a better move here, this true move below it that didn't recover, 4,400, give or take. And then you were able to get back in it somewhere around this level here at about 39.70, roughly lower. And then you've held it potentially since then. Maybe a quick move in and out during this period where you missed and got a little bit of a shakeout. But that's the idea of moving averages and trend. And the idea of trend following is that we're looking for accumulation to be taking place that we can ride the momentum of. And in the event it starts to subside, we're willing to wait for prevailing winds to be back in our favor. We're not ever in these types of trading scenarios going to find this top, this bottom, this top, this bottom. We are not traders trying to pick tops and bottoms if we are using trend following techniques. We're trying to capture the predominant move of a trend in a risk managed way. If you had caught this move, by all means, from 2,200 to was this 4,800. In that case, a 2,600 point move over 100%. That's an excellent trade. But what was the reason for being long here, absent that forward thinking knowledge? At that moment, it would have felt kind of just catching that falling knife, which sometimes that works out, but sometimes you end up with a cut. That being said, we are already a few minutes over here today. Do appreciate everyone joining us here as always. Like I mentioned a few times today, I'll be back Thursday morning at 10:30 Eastern time with these colleagues from iShares. It's not the first presentation I've done with these ones in particular, but usually very informative. It is looked at through the lens of their products to some degree, and of course them being slightly biased for their own products, but we'll still try to keep things as unbiased as possible through the lens of the benefit of ETFs and what they give us as far as the abilities as traders. Any final words that you have, Nick, before we wrap up though?
Maybe I just want to also address kind of what you're saying about Thursday as well. Though for those that might be interested more the stock research side, the individual stock picking, come join Matt and I tomorrow, as opposed to Thursday. Tomorrow at noon, we're going to be talking about the Stock Research Center for an hour. Should be a great class as well. Again, thank you for joining us, everyone. We hope that you've gotten a lot of information out of this class. I'll be back in about 30 minutes with Robert for our midday market briefing. Take a look at how everything's been going. It looks like things have been going real well with volatility's back down. VIX is back down to about 25. S&P is up about 2% and such. A little bit of a breather compared to yesterday. With that, again, take care, everyone. We'll talk to you later. Bye.
Take care, everyone.